You are listening to Digging In Podcast, presented by Rooted Wealth Advisors.
Hey, everybody. Welcome back to another episode of the Digging In Podcast presented by Rooted Wealth Advisors. I'm your host, Kincho Kelly, helping you answer all those questions to and through retirement. And today I'm joined by my man, back by popular demand, John Savarino. How you doing, buddy?
Hey, I'm feeling pretty good. I'm feeling really good, actually. So I'm excited to be back. Got some awesome feedback on the last episode. So excited to speak to more questions and concerns that you have to bring me today.
Hey, that's awesome. Happy Cinco de Mayo, by the way. Did you get your tacos today?
Yeah. Actually, the boss man, Mr. Zach Gray, ordered in some tacos, and Carly and I were even nice enough to share it with our attorney team that we share an office and have retainership with. So they were pleasantly surprised, but very genuinely happy and thankful. So it's been a good day. It's been a great day.
That is really cool. So a few things have happened since the last time we had a chance to talk, at least on the podcast, right? So you are full-time taking care of Champaign and Bloomington clients now, right?
Yes, that is 100% correct. For those that maybe do not know, I've actually relocated to Champaign, very, very recently. So, and it's been quite an adjustment, but I feel so privileged and thankful to be in the position that I'm in. I love, the Champaign and Bloomington communities. I'll always have my roots, specifically in Ashcombe and in Bourbonnais, and I'll always spend time up there. But it's been a great couple months since I've been down here. So.
Well, the hair's looking fresh, so you must have found a new barber.
I got some flyaways. I mean, a couple weeks overdue.
Hey, looking good. Hey, I wanted to start off asking you about the stock market. I know when we've done events, you've gotten peppered. It seems like every time we're out about like, hey, what do you think about the stock market? Hey, it's gone down. Hey, is this the worst start ever? I just wanted to give you like, hey, this is your chance. Now that the first quarter's over of 2022, what have you seen? What's kind of caused some issues? And where do you think we go from here?
Okay, we're going to get into the weeds. So I'll back the bus up.
You always get into the weeds.
True. So I'll back it up to like November. Back in November, Zach, Jackson, Joe, really the whole advisory team, we were guessing that interest rates were going to be rising exponentially, that we haven't seen in a very long time. Inflation, we knew at that point it was at a very high point and was kind of continuing to become higher. So, at that point, we were making a lot of changes for our clients and their portfolios, becoming a lot more value driven, taking a lot less long-term intermediate bond exposure in those different portfolios. And it played out pretty well, right? But so year to date, we are in one of the top 6 or 7 worst year-to-date starts in stock market history. And that can be really unnerving for a lot of investors, especially if you're nearing retirement or in retirement, and I think the irony behind that, or what makes that even more uncertain for a lot of folks, is that the bond market's doing just as bad as the equity market, which we haven't seen in 30 years. Traditionally speaking, equities and bonds are going to have an inverse relationship. That bond portfolio or that 60-40 split will provide some stability in an equity down market. You're not seeing that today. So identifying where that opportunity is at, a few months ago and even today is just of the utmost importance, and not panicking, right? Because when we panic and begin to make emotionally driven decisions, that usually does not play out well, right? So like having a plan, I think, is really, really important for these types of situations. But I think today, like what I'm looking at, right, where I would want to be is like fundamentally, if I'm in individual equities, fundamentally sound, value-driven companies is extremely important. What I mean by fundamentally sound is, who's not leveraging a lot of debt, right? Because as interest rates rise, that debt's going to cost a lot more. And I'll explain further here in just a second. But just healthy balance sheets, really good revenue, really good income, that if this is to kind of go another 2 or 3 years, that at the end of the tunnel, they're still going to be there, right? That company is going to be there. If I think bonds are still important to have as a piece of a portfolio, but I would be looking at more short-term type bonds or short-term treasury bonds. I would be avoiding very long-term bonds unless our time horizon is significantly further, because I do think as interest rates continue to rise that you're going to see over the next 3 to 6 months further volatility in the bond market, specifically intermediate and long-term. And then just identifying these different sectors that you can still find some value in. I believe that financials are a place to be looking at. And what do I mean by that? Banks, institutions, because whether we like it or we don't, as interest rates rise, those profit margins actually rise for them too. So as Q2 and Q3 earnings are released, those will look good for those companies. Utilities, I still think there's a lot of opportunity in utilities. Consumer defensive, like we still have to buy the cleaning products, food, things of that nature. Like those are a good place to be from an equity type position. But I'm not a fear monger or doom and gloomer, but I think anyone that thinks this is behind us, you're probably mistaken. And I think we're in for some volatility in the short term, definitely. But fun fact that I just read a couple days ago, there was a chart, right? And I this could be misspoken, so full disclosure, right? But so we're off to one of the worst year-to-date starts in stock market history in 100 years. And out of those, I think it was 6. So out of 6, 5 out of 6 times when we're off to a worse year-to-date start history, we've actually closed positive. Now, I'm not saying that's going to happen, but I do find that very intriguing, when you describe it. And I'm kind of rambling a little bit, but back to kind of where I see things, like growth-driven companies or growth-oriented companies do a really good job of leveraging debt for that growth. And what you've seen over the last couple of months is those growth companies have gotten hit really, really hard because of the increase in interest rates. But those are just pretty high level, synopsis thoughts that I have.
High level, but when you say, hey, we're going into the weeds, I know you are gone, my friend.
Yeah, I admitted it this time.
Hey,
you
did.
Admitted it.
You let me know up front. So when you and Joe and Zach and Jackson are sitting down, I mean, you guys have over 30 years combined industry experience in this. When you're guessing, like it's more than guessing, right? It's right. Educated, it's informed. You're looking at history, you're looking at models. It's not like you're throwing a dart at the wall and picking, right? Like you're picking, like you said, value-based companies that have a healthy bottom line, enough probably cash flow to tide them over in times of need, stuff like that.
100%. So we work with a lot of really great, CFAs. We have an awesome CPA team, some of the biggest third-party money managers on the planet, that help us with the day-to-day trading with some of those positions. But yeah, we're not guessing, right? We're in a very sector-driven market. So we're very intentional with the changes that we make for our clients. We have been very intentional with those changes. Definitely not a guessing game. So maybe I misspoke there, but yeah, when we do our monthly or every Monday, our weekly advisor meetings together, it's high level to start. And then we really get into the nitty gritty in terms of what makes sense and what doesn't make sense. And then usually by the end of the day, we're kind of running down that track.
I knew it wasn't a guess. I just wanted to clear the air because I was
I'm glad you cleared the air.
Hey, I just hear it a little different, right? I just hear it a little different. John's not out here guessing. John has a very informed position.
We have a process to follow.
Yeah. And the other thing that you said that kind of struck me is the difference between like good companies and bad companies, like managing debt in a way that makes them profitable. I'd like you to touch a little more on that. Like there's good debt and bad debt, right? Like good debt would be like mortgage on a house, right? You're paying on that, but the house is also increasing in value. And then bad debt, right? Like having a huge credit card balance and they're charging you, 24%, on the money. How does that relate to looking at like businesses? Is that kind of the same way? Do I have kind of a baseline understanding or am I off?
It's different. A lot of like growth companies are leveraging like operating debt, so to speak, because they're still in the growth phase of their company, whether they're whether they have a market capitalization of, hundreds of billions of dollars, they're still scaling their business, right? So, the operating debt that they're leveraging, or like this marketing debt that they're leveraging, is they're just investing so much more dollars into their business, that they keep a high note on hand. And honestly, it's played out really, really well for a lot of growth companies over the last 10 years. But we're just in a completely different environment from an economic perspective and from a stock market perspective. So that debt is just becoming a lot more costly to these companies. And in simple terms, it's impacting their bottom line.
Okay. Thanks for clearing that up for me. That helps me understand it a little bit more. I'm not a financial advisor, obviously. I'll leave that to you. But that does help me understand it a little bit more. John, I was talking to a lady the other day, a client that we have out of Texas, and she said that her husband and they just purchased a 100-year-old hotel. 100-year-old hotel. They're gonna refurbish it. It's got 6 rooms. It sounds really cool. Strong lady of faith. She wants it to be used like in some kind of faith-based thing for their community. Really cool. But got me thinking, like, who buys a hotel in their retirement? It got me thinking, like, what is the most, I guess that's a planned expense, right? You don't just happen to trip and fall into the purchase of a hotel. I would think that would be a pretty thought out thing. But what would be the biggest unforeseen cost in retirement that a lot of people just don't see coming, that if they're not careful, their retirement could get derailed?
I think it's twofold. Actually, there's three answers to that question. I think the biggest one is going to be healthcare, right? And specifically, like long-term care expenses. Believe it or not, like if you just group healthcare expenses as a whole, if you compare it to any other cost and goods service, in our economy, it's the fastest growing cost, like by a far and large margin than anything else over the last 20 years. But long-term care is definitely going to be the number one unforeseen expense. And actually, traditionally speaking, less and less companies, I actually only know 2 companies that write traditional long-term care insurance because of, how much it costs. But I might be misquoting it here, but on average today for a decent facility, about $200 a day of care, $8,000 to $10,000 a month. And on average, if you need any type of long-term care, you'll be there for about 2 to 3 years. So you can do the math. That's hundreds of thousands of dollars that could, have an impact, not only on our own, retirement, but also our legacy if we're wanting to leave one. So that's usually the most unexpected expense. I believe taxes. Everyone knows that I'm a tax fanatic. And I think that taxes are the most unexpected expense in retirement. And, maybe a lot of our listeners or watchers are thinking to themselves, how is that possible? And it's really just, required minimum distributions. Like that's going to cause a lot of the unnecessary taxation. And depending on, the particular scenario, estate tax should be a big concern as well. But lastly, one of the other unexpected expenses is sequence of return risk, right? We talk about that a lot in our office, but those that have enjoyed this 10-year, 12-year run of really great growth in the stock market, for those that are like retiring now or just recently retired, that are taking the same type of risks that they were 5-10 years ago, I would definitely be taking a second look at our portfolios, because it sounds cheesy, but like we're not here to hit home runs at this stage of the game, right? We're here to hit singles and doubles and live this retirement lifestyle that we've dreamed of without taking unnecessary risks. And sequence of return risk will be the knockout blow to one's retirement. So I believe that's an unexpected expense that's often overlooked.
It's crazy to see at your events, John, how many people start frantically taking notes when you start talking about that sequence of return risk. Something I certainly didn't know about, or at least know that it had a name. But
right.
Let me see if I have this right. It's continually taking money out of your retirement accounts as the market's going down. So your account's losing value, and then you're continuing to withdraw money, therefore decreasing the account. And there's a slide we show, and it's the same average rate of return for both couples,
Right.
but one couple runs out of money way before the other one. Just goes to show that the average rate of return that a lot of companies out there are selling maybe isn't that shiny.
Correct. I mean, I think so compounding interest is so powerful, right? And it can work in our favor even while we're taking distributions. But as soon as if you're down even just 5 to 10%, and then you're also pulling out a 2, 3, 4% distribution from it, you're effectively realizing losses on that money that you're taking a distribution from, but you're also effectively reducing your compounding interest power on those dollars. And it takes a lot more gains to offset lesser losses. And what I mean by that is if I had a 10% loss, a 10% gain is not going to offset that. More than likely I'll need a 15% gain or something a little bit higher. That's the concept. So that, along with actually taking money out, it just becomes an extremely slippery slope that some folks just don't have enough time to recover from if they're taking unnecessary risks, or they just don't have a portfolio that's positioned well for their retirement needs.
And if you need the money and that's the only spot to take it from, you're kind of stuck, right? So it it lends itself to, you got to have a plan in place before you get to that point to help mitigate some of that risk.
Yeah, I mean, and I think that's the power of working with a financial advisor, right? To have those tough conversations. I had a client that I recently onboarded a few weeks ago, just an awesome person. And she sent me this email yesterday evening, and she said, "John, this is why I hired you. And this is why I'm like so appreciative of you." And like, it really like melted my heart a little bit, made me feel good. But it was like why, folks should work with a financial advisor. And it was just, it's a lot more than performance, right? It's a lot more than performance. And I think she was really genuine when she sent me that, and it meant a lot to me. But that's the power of working with a financial advisor, that especially one that's going to take a look at our situation from a holistic perspective to, once again, prevent unnecessary risks. When you're 20 or 30 years old, long-term growth and accumulation is going to be one of the best tools to build wealth. But when you're at this point in time, for most of the folks that come into our office, like, they're at the finish line or they're darn close. So if you're at the finish line, right, if you're on the last lap of the Daytona 500 and you got a 20-second lead, is it worth, stomping it all the way to the floor and taking unnecessary risks around the corner? No, let's just get it to the finish line. And like, that's the comparison that I like to use. Like, if we're already there, like, it's not worth the unnecessary risk, knowing that you could lose everything you have.
That's super important. Working with a good financial advisor who's looking at everything. Do you know somebody? Do you know a good one?
Gosh, what's his name? John. Can't pronounce that last name, but he seems like a decent guy. So
all right. Well, I'll let you go. But first, I caught that racing analogy. You racing this weekend?
Man, weather has not been our friend. I actually haven't even been on the track. We've tried 3 different times. Weather has not been our friend. So I actually have pretty stacked weekends. Actually, this weekend, my cousin, shout out to Kyle, we have a bachelor party for him in Milwaukee. But then after that, it is back-to-back weekends of racing, which I'm super stoked about. But as many of you probably know, we've done a lot of changes to the car. So totally going in blind. So I'm anxious to kind of see how things play out, but I'm confident in my father's abilities and my abilities. So really excited about it.
Hey, I'm excited for you, man. That's going to be awesome. We need to do an episode with you in the driver's seat, answering questions about the car. Yeah, we can do that at another time. But today we'd like to thank our presenting sponsor, Rooted Wealth Advisors. If you had any questions about anything you heard today, give them a call about today's show. It's 815-918-4727. You can also get your copy of Your Retirement Lifeblood. It's free. John helped write a chapter in this on tax buckets. Be sure to check it out. That's it for us today. We'll see you next time. Until then, keep digging in.
This was Digging In Podcast, presented by Rooted Wealth Advisors.